Hello. Today I'm going to tell you a story about a couple who bought and sold 5 houses in 6 years. And they claim the principal residence exemption on all of them. So the principal residence exemption is a tax law or tax rule where if you sell the home that you're living in, there's no tax on it. There's a calculation that goes into that to make it zero tax. So it's not just you sell your home, it's no tax. But for the most part, when people sell the home that they're living in, they don't pay any tax on the difference between what they bought it for and what they sold it for. So this story is a little bit different though, because the idea of a principal residence exemption is just that, you buy a house and you live in it for a while and then you sell it. And if you were to pay tax on that every time you sold it, then it would be prohibitively expensive to own a home. And so this family had bought a home that they had thought that they were going to live in for the foreseeable future. And then it turned out that it was very noisy. There was a bunch of trucks going to and from a construction site, and apparently it was bothering their baby, and they didn't love some of the layout features. And so they're like, okay, we're out of here. We're going to sell. So they'd only been in that home for a few months, but they were like, we can't do this. We're selling. So then they sell their house. They buy the next house. Now they're in house 2. And they have cited that there is a coyote invasion. There's coyotes everywhere. They're loud. And we just can't live here. We're out. So a couple months later, they sell that house and they go and they move somewhere else. And so they have built house 3. House 3, they actually built from nothing. And they moved in and they loved it. And then apparently they got a unsolicited offer from somebody that they just couldn't refuse. And so they decided, oh my goodness, we have to take this. We're going to sell this house. We're going to move somewhere else. So they do. They sell this house. This is house 3. They are now into house 4. And so while they're living in house 4, they buy a plot of land that they're going to build a new house on. And they buy permits and the whole thing. They're definitely going to move into this house once it's built. So they're living in house 4, and then there's parking issues, and the people are the neighbors are complaining about the noise, and they're like, oh, you know what? We can't deal with this. We're moving. So they sell that house. And then now they're into house number 5. And so they're in house 5 and it's fine, I guess. And they stay there until house number 6 is built. And so they sell house 5 and they now move into house 6. And so for all of those years, it was 6 years that they had sold those 5 houses. And so on each one of the tax returns, they claimed the principal residence exemption for each one of those houses because their intent had been to live in those houses for the foreseeable future. They had not intended to actually sell those houses when they bought them. So they filed their tax return. They'd consulted a professional, and the professional had said, yeah, based on what you've told me, these are all principal residences. And so, yeah, we can claim this exemption. The CRA, on the other hand, was like, no, you own a concrete company, sir. You actually have to pay tax on this because it's business income. We don't care that you actually live there. Your intent was to sell these homes to make a profit, to sell them quickly, not just to live in them for years and then sell them. And so they took them to court. This couple was like, no, we're going to court over this. And so the first 3 homes, the judge decided that, in fact, it was too long ago for the CRA to actually reassess them, which is super interesting because generally there's a normal assessment period of about 3 years. So the CRA can't go back more than 3 years to assess your tax return unless there's a careless mistake. That's what they've decided. There's a careless mistake, and so they can go back more than 3 years after the date of the notice of assessment was issued. So that happens all the time where they're able to go back more than 3 years. But because this fella had consulted a professional and they had decided that the principal residence exemption did apply here and that they had taken a position on this issue, it wasn't the same position as the minister. So they had a different opinion, but they had made a decision about this, that it was not a careless mistake. Even though the CRA didn't agree with what they had said, it wasn't careless. They had made a decision and they thought it through. And so the judge had decided that those first three houses, the tax returns involved, were not able to be reassessed because it was too long ago. So that was super interesting to me, that they could not go back because they had consulted a professional and had actually taken a stance on that issue. Houses 4 and 5, though, because this couple had bought a plot of land and had, permits that they had registered for, and they had gone ahead and built this other house while they were living in houses 4 and 5, the intent was never to make house 4 or 5 their long-term residence, because they had this other property that they were going to move to. And so in the case of house 4, they decided that yes, in fact, this was business income for this fella who owned a concrete pouring company. And in the case of house 5, that this fella had actually seen a desirable market. It was a new development, and he had seen like lines for hours for people to go and talk to the developer, and he had followed up a number of times, and he finally got a lot that had like fallen through, and so he built this house, and then he made upgrades to it in hopes of attracting a new buyer. And that all of these things, the intent of them was to be able to sell for a much higher price than he had actually bought for. And so those 2 homes were assessed as business income. Even though the client had lived there, it didn't matter. The intent behind them was, in fact, to make money. So I think that's super, super interesting, that the intent of all those transactions really is what mattered in court. The CRA actually called the neighbors to the stand. I think it's called the stand. And they like questioned them, and they're like, so what about this coyote invasion? So was it really noisy and there were trucks going back and forth? Like, was there really a parking issue? Was it really an unsolicited offer on house number 3? And in all of those cases, the neighbors actually came back and they were like, I didn't think it was that noisy. Like, the guy had a pretty reasonable price in mind, so I didn't think it was like too good to refuse kind of thing. The court actually did side on the side of the client, like of the guy who had sold the houses, because of a bunch of other things. But I thought it was super interesting that they'd actually called the neighbors to be like, was what this guy is saying true? So I think that's like, the intent matters. The intent of those transactions mattered. So that's really important when you're creating transactions, or you're doing something that's going to have a tax impact. It's really important to keep in mind what those intentions actually are. Is it to evade tax? Because the CRA is going to find out. They're going to call your neighbors to the stand. They're going to ask them, and they're going to figure it out. What was your actual intention behind that transaction? And if it was to try and evade tax, they're going to hit you with a really big penalty. The gross negligence penalties for claiming the principal residence exemption, even though maybe they shouldn't have, were waived because they had consulted a professional and followed the advice of that professional, and they had, gone through the rule, which there's really no hard and fast rule on that principal residence exemption. So the interpretation of it was reasonable. So that was waived, but that's 50% of the tax that should have been owing. So that's significant. Let me know in the comments, what would you have done in this situation? Would you have claimed those residence exemptions? Would you take the CRA to court? If the CRA came back and assessed you for like 5 or 6 years worth of taxes, and it was a significant amount, like he was selling houses, would you take them to court, or would you pay it? I'd love to know. Let me know. If you have any questions about any of this, let me know in the comments. I would love to chat about it. I find this case very interesting. And if you'd like free tax and accounting tips sent to you every week, then sign up for my newsletter. I left a link in the description. I hope you're doing well, and I'll see you tomorrow.